Hello and welcome to the week of September 28th, 2015. And, the markets last week lost a little more than 1 1/3%. And the S&P 500 is still down from where it was a year ago. Now, of course, that's probably going to change over the next few weeks as we process through the dip that the S&P 500 took in mid-October. But again, that's going to be relative as well because the numbers then turned around and spiked back up in early to mid-November. And frankly, I think we may be headed towards that same path again because of earnings coming up. Third quarter earnings are going to start coming out in a couple of weeks, and I think that had a lot to do with the spike a year ago. And earnings still remain strong here in the United States, so I believe that attention getting away from China and some of the foreign issues and into the domestic market will be good for the market for the remainder of the fourth quarter, or at least for the month of November. So still taking a look at that, I want to briefly head over and look at volume real quick. Volume dropped last week almost down to where I talked about it really needing to be for a calmer market, around 3.5, 3.6 billion shares per day. The month moving average has now fallen. It was 4.1 billion shares per day last week. Now it's down to 3.8 billion shares. So I'm going to keep an eye on this again. As you can see, the last 2 days of the week had some high volume trading. The last thing I wanted to talk about before concluding for this week is the unemployment report. The jobs report is due out on Friday for the month of September, and I just wanted to show a few charts discussing the jobs report because really it plays a big role in what the Fed's decision making is going to be. And one of the positions I've had is that slack appears to be coming out of the labor force. You could see we had at the peak of the last economic cycle 138 million non-farm payrolls. We dipped. We lost over 10 million, and since then we have rebounded back up nicely. We're now over the 142 million non-farm payroll number, so it's a nice increase from the last payroll cycle. But there may still be some slack remaining in the jobs market as the unemployment rate, while it is at about 5.1%, and unfortunately it's the chart's not going to cooperate with me today, but we were actually at under 5% in the last business cycle for over 2 years. So I think the Fed is looking at the labor market as improving, but not quite in their ideal sweet spot to raise rates. Again, I disagree with that position, but I'm trying to figure out why, other than global weakness, they're keeping rates at zero. The other thing is the average duration for unemployment is still much higher than it was at the height of the last business cycle. So there's a few indicators out there that I think the Fed wants to see improve before they give the okay to start raising rates. And maybe one of the things in their defense is that once the Fed starts raising rates, I think the market is going to essentially imply some type of rate hike policy where within the next few meetings beyond, they're going to raise it another quarter or raise it another quarter. So they're really wanting to try to start a ladder, and in doing so, they want to, I think, get off on the right foot. Outside of that, it's going to be a pretty quiet week ahead of earnings. Like I said, we're about 2 more weeks away from that. I hope everybody has a great week and good luck investing.